Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So, a lot of turmoil in the Middle East, specifically between Israel and Iran, obviously, in the midst of also Israel in a conflict uh, with Hamas in the Gaza Strip region. But over the past week, since missiles have been going back and forth between Israel and Iran, we have seen a shift higher in oil prices and bond prices as well. So safe haven, along with the continued concern about the supply with oil in that region. Fed meeting, middle of last week, no surprises in terms of what the Fed did with their actions. They did hold rates steady, and expectations for rate cuts the rest of the year still at 2. There was a bit of a shift underneath the surface that I think is worth monitoring. And finally, as we look at the labor market, it is much better in balance. Powell mentioned this, had a quote at the meeting talking about it's looking more and more like it's in balance. Let's look at a couple indicators that supports that narrative as well. So Israel-Iran war is boosting oil and bonds. This table shows the total returns for the four areas of WTI crude oil, S&P 500 US stock index, the MSCI EAFE index, that's going to be your non-US stocks or developed international stocks excluding the US, and finally US investment grade bonds as represented by that Bloomberg Ag index, pretty much like the S&P 500 of the bond market. And you can look over the past week. Remember, Israel had that surprise attack on nuclear facilities and other areas across Iran that started last weekend. And then there's been a bit of back and forth over the past week. And you can see just in terms of price action, crude oil is up 3% over the past week. US stocks pretty much flat, international stocks down a bit. And then US investment grade bonds boosted. You have the 10-year yield down about 20 basis points over the past week or so. One other note, crude oil is up more than 20% during the month of June. That's the steepest increase that we've seen in oil since 2020. There is a lot of concern even pre-Israel-Iran because of the conflicts that were going on in the Middle East over the past few weeks around disruptions to the Strait of Hormuz, which is really that waterway that comes out of the heart of the Middle East between Iraq, Iran, and Oman, and those areas that brings north of 20% of the supply of oil. Iran has responded and talked about, hey, we can turn this off. In fact, we may do that if this continues to try to impact some of those other areas. So that will be something to monitor and something that the oil markets are pricing in with this increase, that potential for impacted supply. Now, in terms of the Fed, this chart's going to be a lot to take in, but this is the Fed dot plot in all its glory here. Looking at basically what are the Fed's expectations over the next few years, including the longer run. And we see two sort of columns of dots for each respective year. And the first column in the light blue is going to be March. So what did they say the last time they produced their summary of economic projections in March? Remember, these only come out each quarter, even though the Fed meets more frequently than that. At the June meeting, we got their updated revision or updated dot plot. And the dot plot tells us how many members voted or expected the Fed funds rate to be at various levels at the end of each respective calendar year. So we can see at the end of the June meeting, you had 10 voting members believe that the Fed was going to cut 2 or more times by the end of 2025. And if you look at the number that think they're not going to, it's 7 that think it's going to stay put with 0 cuts. Remember that 7 has increased from 4 up to 7. You can see it at the very top of that 2025. So a little bit more of a hawkish undertone to the Fed, but still saying 2. You saw a little bit, the total median expected rate cuts in 2026 also went from 2 up to 1. So I would say underneath the surface, you're seeing a slightly more hawkish Fed. And when I say hawkish, I mean a slightly less likely Fed to be cutting aggressively. And some of this is because tariffs and the uncertainties in the Middle East. If you look at some of their expectations around the economy, they also expected lower GDP growth, down from 1.4%, closer to now around 1.4% rather after that meeting, down from 1.7. And then also, if you look at inflation, they expect core PCE to come in a little north of 3% for 2025. So slightly higher inflation expectations and slightly lower economic projections. That equates to the Fed being a little bit hawkish in terms of expectations for Fed cuts. But still, right now, two cuts, but more dispersion and disagreement within the committee. So I'd say there's a more uncertainty around those two cuts than there was back in March. Now, one of the comments Powell mentioned was labor market largely remains imbalanced. I think he's right. And when you look at inflation, which we don't have a chart of that here, that's still running slightly above the Fed's target of 2%. And the Fed has some concerns about inflation, but the labor market is largely looking pretty nice. And it has cooled, and it's not as frothy as it was back in 2022. On the chart here, we have the red dotted line are the number of job openings in the US economy. You can see that came in at about 7.39 million open jobs available for people to be hired, and unemployed is just below that. So really, really close. That ratio is about 1 to 1. And if you recall, and you can see as evidence on this chart, back in early 2022, you had a massive gap between those two areas where there were a lot more job openings than job seekers that were unemployed. That led to some wage inflation, and it was contributing to that inflation that the Fed was trying to combat with higher interest rates. Well, that's not the case anymore. Wage growth has moderated, perhaps a little above target, but nowhere near where it was in early 2022. What this means for the job market is that employers are probably going to have a little better selection for employees when they're trying to fill jobs, and job seekers are going to have a little bit less maneuverability in terms of options for jobs. And also, we've already seen the quit rate, or the amount of people that are actually quitting their job to relocate and find new jobs, that those have come down as well. So there's not as much slack in the labor market. It has definitely cooled over the past few years, partially because of this high interest rate environment, but partially just because of that massive supply item we had in 2022 that led to that inflation, at least from the wage perspective. So we're not likely to see inflation from the labor market anytime soon. But the bigger concern is, do we start to see further cracks that's going to force the Fed's hand, even though inflation's not at that target? That's that sort of stagflation light that the Fed's been sort of simmering, talking about as a potential concern if that happens. Low growth, high inflation, that puts them in a bit of a tough situation. Now, speaking of tough situations, it's a cool picture. We've got a spaceship with a net grabbing something in space, all right? Well, it turns out we have a lot of trash in space. And by trash, I don't mean wrappers from Big Macs and fry boxes and trash bags. We have a lot of debris, and there have been over 30,000 tracked objects from just different orbital missions where different metals are rotating within the Earth's orbit. Now, these could affect GPS, telecom, satellites, and things like that. We're starting to see, and this is not brand new, but we're starting to see more and more of this, of these private space startups, which are getting these government contracts to be able to go up and do that, that are trying to go up and remove that orbital debris to really clear these items that we're not using so they don't impact GPS and satellites and things like that for space travel, or for looking up at telescopes, or even sunlight not blocking things like that over time. So interesting project cleanup. I just called it that. I don't think that's the official name. But yeah, let's go ahead and clean up that junk that we're not using. I'm sure that can't be good for the Earth overall. With that, I want to thank everyone for watching, and I'll see you next time.